Welcome to G-Money Real Talk on everything mortgages and real estate. And today I have a treat for you. I am here with Mr. Eric Olson.
I don't know if it's a treat.
Yes.
Is it? Okay.
Here it is. Self-declared. Maybe there's a certification. I don't know. You are the non-QM specialist.
Okay. Thank you for that.
Does that work for you?
Yeah, it is. It does.
Okay.
It does.
Pull it in a little tighter.
Let's do it.
Make sure everybody can hear you. And
Yeah.
I'm not saying make out with the microphone, but we want to make sure you're present here.
You got it.
Yeah. Okay. That's what we're here to talk about is non-QM, your specialty.
Mm-hmm.
It is a growing market. We're going to get into that, but let's kind of properly introduce yourself. You are an account executive with Angel Oak.
With Angel Oak.
Yep.
Great company. Been with them for, I'd say, a little over 8 years now.
Okay.
Got the start back in 1998 with Weyerhaeuser WMC Mortgage down in Woodland Hills.
Okay.
So started off as a receptionist.
Oh my gosh.
And I never told my wife this until
You would
she
be a
called.
beautiful receptionist,
I
I'm
would
going to say, because
Thank
you
you.
are the best dressed in the industry.
Thank you,
I started out strong.
Yes, thank you. You are. Yeah, I never told her, and then she would call into the office. She goes like, "Hey, babe, why are you picking up the phone every time I call?" I'm like, "Well, why are you harassing me?" But so, yeah, and then got into sales in 2001.
Did you have any mortgage background, or was just
Didn't even know how to spell the word mortgage.
Yeah,
it was
that T in there throws everybody off.
I thought it was a dash. And so no, it was no experience, but I saw the hunger, the desire. Everyone had such high energy going into the office, and that was infectious.
Yeah. Well, commend you for really going through the hoops, and it's almost better to not have a crazy background in it, because if you know what you're walking into, I think that's called stupidity.
I agree. Yeah, I don't know if I would do it again, but happy to be here. Yeah.
I'm going to say I started out in title many moons ago. Actually, in high school, I worked for Stewart Title in their warehouse, just menial position. I had nothing. They paid well, and it was a good job. And I was like, okay, cool. And then went to school down in Santa Barbara, and then through my contacts at Stewart Title, I got picked up Fidelity in Santa Barbara.
Okay.
So then it was pulling deeds and customer service stuff, going down to the county and pulling death certificates. I mean, it was non-glorious by any means. But then that's also given me a good, hey, I can read a preliminary title report better than most.
Sure.
It's given me definitely a solid background. This industry is very rewarding. It's very amazing.
Yeah.
But there's also challenges, and I think if it didn't have its challenges, there wouldn't be the rewards that they are.
Yeah.
And you just hope that the peaks are as strong as some of those valleys are.
Sure.
Right?
Yeah.
The net positive needs to be to make it
If
worthwhile.
we could know how long the valley was going to last, that would be better for everybody. But
and for our clients, we do not have crystal balls, and all the information that we do research and listen in on, it's speculation. And look at our federal government, how many economists they have hired, and their Federal Reserve Board, and they're still But
well, and I to add on to that, I think it goes to the seasoning of how long you and I have been in the business to share the trends that look familiar to us, and then give an opinion on where we think it's headed.
At the end of the day, look, I don't want to be Debbie Downer. I am Mr. Positive. I truly am. Housing drives 25%, if not more, of the GDP. The government's not going to let housing die. I'm hopeful, and I feel that we're not the same dog that's going to pee in the same spot twice, that a lot of what's caused different recessions and crashes, those factors aren't compounding like they are today. And are there challenges today? Yeah, absolutely. If you look at what it takes to run the government, I don't want to get over technical here, but as your left hand is elevating this, your right hand is dropping this, the inflation is going up over here, it's just like this vicious cycle. And how do you get everything positive? You can't. That's the bottom line.
Yeah.
We have to also be very realistic. There's ebbs and flows. Overall, if we still have a strong economy, we we look at, hey, before we got started, hey, rates are higher than they've been in the last 13 months. We're both doing well, right? Yeah. Something to be said that give people the right tools and education, they're still going to purchase, and they still believe in housing, and they have us to guide them. So boom.
Hey, we're out of here. Let's do it.
Yeah. Well, with all this stress that obviously comes with the industry, I'm very curious, what's a little bit about you? What's your passions and hobbies, and how do you decompress from this industry?
Geez. How do I decompress? I don't know if you ever really do. What I like about the industry is we have the ability to get to know each individual and their scenario.
Yeah.
Right? And so mixing business with fun, we're always having to be on in sales or customer service.
Sure.
And so when we have that opportunity of not having to be on, exercising and being alone with my earbuds is always a nice break from the intensity of what we do. Yeah. So,
when you're exercising, do you not return texts? Do you not answer calls? Do you fully disconnect?
If my bills didn't arrive every 2 weeks, I'd say I'd love to. But no, there's particular times in a day where you just know that force of, okay, I need answers, right? And that's for us, not to speak on your behalf, but for me, it's in the morning, right? And the intensity of, okay, I need answers early enough because you most likely are meeting with the client after hours, right? You're going to get back to them. Well, you need to get back to them a certain amount of time. So knowing when to take my breaks, my mental breaks is always important. But I'm always on because again, you pay my bills. So
well, I can relate. My honeymoon was in Thailand, and I had my laptop with me.
Yes,
I maybe wasn't making
good
the phone
wife
calls that I was, but I was definitely on my laptop and doing what I needed to do to fund that enjoyment.
Yeah.
Here's what I would like to say, and I'll explain this dynamic a little bit too. I always like to explain, if somebody knows nothing about mortgages, that's what this conversation is about. Let's educate them, fill them in. That's kind of the way I do business, is educational. Yeah. I'm not pushy. I'm not here to hound you. But if I hold your hand and explain it, man, they're going to feel more comfortable in making those decisions. Hopefully I'm there to be the one that they say yes to. One of the things, and we're just going to explain, Angel Oak is a wholesale, probably a correspondent too, but for our conversation, we're just going to say wholesale. So my company, American Pacific Mortgage, we can fund our own loans, but there's a lot of different programs out there, and we don't fund everything. And so we can go to other companies such as Angel Oak, and on a wholesale level, then we can utilize their services. They will underwrite it. They will fund it. We act as the guided middleman to direct traffic, more or less.
That. I look at us as one of the options you can use, like a restaurant, right? Yeah. We offer the same type menu, but where does the service come in? Where's that trust come in? I think going kind of left to go right is the term non-QM hurts the business because they're going, well, what does that mean, right? Because we're used to Fannie Freddie, and then you throw this, well, non-QM. It does a disservice to what we're offering because it seems like you're not on the A team, right? Well, why am I having to go to non-QM? Why are you sending this to an Angel Oak as an option?
I've never thought of it like that. My, again, positive outlook is not like maybe what you don't have, and I guess that is the phrase of non-QM. We're going to get into what non-QM, or rather what is QM, right? To me, the way I explain, in a nutshell, non-QM is, for the most part, not everything, it's alternative programs for lots of self-employed borrowers, right? Exactly. And that's probably the number one challenge that we have in any lending. Now, put that into context. Most of the guidelines, the agency, Fannie, Freddie, they're archaic. Yes, they update them frequently. They're very black and white. They're very set in stone. 2 years, you have to have this. You have to, I don't know.
It's good.
I'm grumbling at them.
I like that. I like that too, because we're bringing a human being behind the scenes, which we call an underwriter, to say, tell us the story about what we're not necessarily seeing
Sure.
on the black and white. And
Yeah.
we are specifically geared towards the self-employed borrower, the pulling your bootstraps up, whether you run a restaurant, you're a musician, whatever it is that you can show monthly income with the deposits
Yeah.
using bank statements versus what your tax returns show. And
Yeah.
that is our number one client is a self-employed borrower.
I probably say this to every self-employed borrower that I have is sit down at a table of 4 and you have this tug of war with tax returns. Okay. We have the same document. The IRS wants you to pay as much taxes as you possibly can. State of California too. I haven't forgot about you, Mr. Newsom. You go to the other side, you have the taxpayer. For the most part, if you're self-employed, they want to pay little to nothing. Then you have the referee, we're going to call the CPA, okay? They're trying to appease both. Here's what we can push, here's what we cannot push. Here's how I've always prepared a tax return. And then we get introduced. CPAs hate us, right? Yeah. Because we ask for things, we question them on why they did it that way. But all we're trying to do is help our borrower get qualified. And, you know, our industry, it's not that we're doing anything wrong or shady, but everything is down to presentation. And that includes the tax return. You can show a loss as self-employed as long as you have the proper deductions that we could add back in, like depreciation, amortization, you know, don't use $10,000 worth of meals and entertainment. You know, it's knowing what these line items are. And so in today's modern mortgages, I think having these solutions, these non-QM solutions, providing bank statements, guess what? We're still showing cash flow. It's probably a better way to look at it than what's on your tax returns, right?
Yeah, there's two things I like out of that. That's where the borrower, your borrower, comes into play, where the communication, the clarity of what you relay to the borrower, what we need from the CPA, and then getting a jump on that early so no one's in the panic mode of, hey, we're days away from the close. And this is when I'm speaking with realtors, I share the timelines with them because really they're the ones telling us in their mind how we should work, right?
Yeah.
But if they don't know how our process works, if I don't explain that to you, to tell the borrower that, hey, the delays in getting this from the CPA or the clarification that the lender us needs is only going to bring additional questions of, well, did I make the right choice? Then it's going back to what is again non-QM? Why am I not? Why is this? And it's what you and I have to compete against is the next door neighbor. You know, because they're the expert that we always have.
And Uncle Freddie, he knows
Uncle
everything.
Freddie, you know, he's smart.
He knows everything.
So we always have to go backwards multiple times. Where if we could set the tone up front of, hey, when you're talking to your CPA, we do need this document, whatever that might be, sooner than later.
Yeah.
Here's how simple we need an explanation of your type of self-employment business, right? I always try to tell you of, hey, let's make this 2 sentences or less. And I'm getting into the weeds of, non-QM should be as easy as it sounds on your podcast, right? Okay. If I tell you the story easy enough that you can just regurgitate that to the borrower, okay, he told me to get this, this, and this, like going to the grocery store, and then I can see, did you get me this, but then you're going, well, where's that, right? Yeah. Oops, I forgot. Well, that oops you forget is a day delay. Right, because what we want to do as the lender is, if you've got a 30-day close, why take the full 30 days?
Right.
Let's try to impress your listing agent. You're buying it. I want to impress you. So I like telling the story of, okay, here's what we got. You qualify. Here's what we need. But the borrower's ability to quickly get on those we needs is what I like to share when we do things like this. Yeah.
And a lot of that is, I'm going to say, without tooting my own horn, I do well. It's my attention to detail, because it's not just gathering. I gather documentation all the time, but are we previewing it to see prior to it getting to the underwriter, something's missing, something's not right, something's a red flag. Yeah. Like, you know, that's the thing, is being that filter. Again, not anything shady, but not just going from the left hand to the right hand. Are we reviewing and previewing it to make sure that when it hits the underwriter, they know a clean file versus a non-clean file. It's all in presentation. And I bet you could give that same client to 10 different lenders and have 10 different experiences based upon how it's presented.
And I look at, like, to give the mortgage industry is, to me, the restaurant industry. It's heavy customer service.
Yes.
Majority of the time, you're going to get the same type of entree options with a different sauce or a different side.
Okay.
And the more, to go backwards again, my job requirement is to make this easy for everyone.
Yeah.
And if it's not the right fit, I need to quickly tell you this borrower is not the right fit with me. Just send them somewhere else, right? And
I love that right there. I have a quote from you. I do.
Oh,
I found very minimal.
I didn't know if I was quotable.
No. On the Housing Wire of July of this year.
That was recent. Yeah.
That was a recent interview that you had. A quick no is the best yes.
It's true.
Oh my gosh. I can't get enough of that, because the more I've matured in this business, the ability to say no is, I think, empowering. I think when you're early on, you want to be a people pleaser, and you're like, yeah, I'll do everything, and I want to make you happy. And I do. I want to make people happy. Here's where it's empowering for what you're saying is I'm going to be frank here. You're a no BS guy, and I am too. We don't have time to skirt around it. Is it a yes? Is it a no? If you come to me for a loan and maybe it's no, you're not just walking out bummed. You're going to walk out of here with a game plan of how do we make that yes later. Right?
Correct.
But people will appreciate you more if you tell them up front than beat around the bush. It needs to be sometimes like keep it simple, stupid. It just spelled out of, hey, here's why. Here's what we're going to do. If you want a house, this is what we can do. But going back to on your side, these non-QM, most of the time, you're aware, these are a lot of questions, a lot of nuances. There's a lot of technicalities that go into it. You and I had an experience, I believe, where we discovered the note holder was a private party, right? And that was a disqualifier. And so it's like, you have to not just run through it, but you have to make sure you're in the details enough. So there's a lot of, when I'm reaching out to Eric, hey, here's a text. Let's jump on a call. You're excellent about that. Your follow-up is phenomenal. When you say you're going to do something, you do it. That is unheard of these days. But the other thing too is maybe I'm not a good fit for this, and I would rather tell you no now so you can find maybe somebody that is a better fit. And that is kudos to you. Thank you. The business that we do is because of that. And, I don't want to strike out 10 times with you, and I don't feel that I ever have or will. But again, the ability to call it quickly and honestly, there's a lot more integrity in that.
Yeah. Thank you. I have a question back for you, and in the process, and more towards the borrower listening to this, because you have the meeting with your client, you give them the needs list.
Yes.
You now know in your mind, okay, this is going to be a non-QM loan. Let's call it a bank statement only loan.
Sure.
We've worked well enough that you already know majority of what I'm going to ask for. So you send the borrower away of, hey, I need this. Mm-hmm. Isn't it interesting that when they bring you back the information, let's just say they got it all right,
okay,
and they brought everything exactly they wanted, that borrower is so hungry for what do I qualify for, because they've already found their dream area or that dream house that they now know it's going up on the market. The borrower's expectation of when they drop that documentation back to you, which then you need to forward to me, they want an answer before the end of the day.
Yeah.
And we know this at Angel Oak. So when you send us that information, we know instantly we're on the clock. We're an F1 team, right? That's how we view it. The stopwatch is everything. So there's a rhythm, there's a cadence, there's a dance that goes along of, okay, get me this, you got me this. Eric, take in. Okay, now you're come back. So we pride ourselves on speed. And again, it's either a speed of this isn't a transaction for us, or here we go, here's the terms, here's the options. Are you ready?
Yeah.
So it's just that back and forth that makes the job fun. Majority of the team I get to be a part of I get to be a part of it. You know, it's a high intensity job because
very high intensity.
It is
well spoken.
There is passion behind the purchase.
Yeah.
Right. Because there's envisioning of the grandkids already swimming in the pool.
Yeah.
And yet we're going through the pre-approval process. So that's the fun side of it, but it can quickly turn into okay, wait, let's slow down again just to see where, the choppy waters have come in this 30 days, and then we're going to get you there. Here's just, everybody hold on. So it's that wave of emotions.
Couple takeaways here. One, and, we're talking about the timing and how quick we need to respond. I go back that I've been in the industry about 25, 26 years. We're going to say common, and everything's negotiable, but the common escrow is 30 days. The amount of processes behind the scenes is at least 10x of what it was 10 years ago. And that was 10 years before that, it was a 10x. So the amount of back end checks and balances, fraud search, this, we do not have a day to lose. So every day is accounted for, and that includes the documentation. Now, the one correction I'm going to say on your narrative that I find, and again, just front-end retail here, is self-employed borrowers, they loathe doing their taxes. So when they're going to look at a home, typically they're finding the home without getting pre-approved. They're working backwards. I'm not going to say it's always the case. I'm just, especially a lot of the non-QM stuff, oh my gosh, I found the home. How do I make it work?
Well, and if I can jump in, the problem now is the realtor either chose not to ask the question of have you gotten pre-approved,
sure,
or they have fudged the answer,
yes,
right, of yes, because they're thinking, well, I know what I make, even though someone hasn't confirmed that,
correct,
as in you,
yes.
And then now the agent has expectations based on the fudging of the reply of have you looked through their documents, and those type of things build lack of trust. I thought questions of, well, you told me, and you're going, well, wait a second, at what point in the process did I find out you had already found home, and now we're finding said loan, and that's just, again, what the dance is off, right?
Yes. Yeah, and that's it. And so again, you and I are problem solvers. That's what we're trying to do. What's the end result? The borrower wants to get into the house. How do we make that work as painless as possible? And it's an art, It's very rewarding, and seeing the clients get into the house and high-fiving each other the day of funding and closing, like, we did that. We did it on time. We closed early. Like, whatever that narrative is, there's a huge sense of accomplishment, relief, and excitement for the clients.
Because we are on a team, and that sometimes I have to remind my inside of how an email can be sent, how something can be said, because emotions are so high. People are instantly offended.
Yeah.
And then because on this other side, people are so happy that they're going to get that house, anything that can be taken that's not a positive. Okay, so we're counselors is basically what
we are all day long. And then, I tell them, I go, hey, you tell your attorney and you tell your lender, you tell us everything. Yeah. I need to know up front. And again, maybe I don't want to work with you. And that's been empowering to say no. And, it's not ideal, but I've seen how some people operate, and that's maybe not how and it's very rare. I will say it's very rare, but a couple names come to mind that I've kind of phased them out in a very nice way of, I think my life is better without the added stress that they may bring into this situation. I have enough stress just trying to do it every, day for the perfect files that are happy to work with me.
Yeah.
So
when my wife listens to this back, she's going to hear me say the word counsel. We're counselors. She's going to tell me you have need more counseling than any person I know. So I can't wait
you
to
have
get
to
that.
walk people through it. And one thing I'm going to speak to the way that I do business. Every interaction with the client is myself. There's a lot of lenders out there, and they have teams, and that's great. Normally when you're lower on the totem pole, you're that middleman and you reach out for stuff. You're not as well qualified. You're not as well spoken. My clients get me. That's why they choose to do business with me. They have access to my cell phone. They have access to me. I'm the only one. So there's no confusion in, I'm going to call them, go over the documentation that I need, but hey, I just hit your email with that in explicit detail. There should be no confusion over what I need. And that saves time. You may invest a little bit more time up front, but in the long game, it's definitely been very successful.
And on that same synergy is, you always have me.
Yeah.
But then it's my job to show that, hey, I'm tired of hearing from you, Eric. I would like to hear from the underwriter who's making these choices. And it's that open book that Angel Oak wants to bring to you and say, yeah, if you want a different opinion, or hey, I see how the condition is read, I'd like this to go to committee at Angel Oak to get a different opinion, to get us to a faster yes.
And as confident and competent, we're going to say those words together, that I am in the business and knowing how to do business, every company has their own little nuances and dynamic. And so as we have done loans together, the first one, I lean on you a lot. What's your process? Walk me through. And you are always very excellent of, here's the procedures, here's what you do. I mean, you explain it without me even asking. Even if we've done 10 loans together, I'm letting a little bit of control go, and I'm probably a control freak too with that. Maybe we are in counseling together right now. Are you going to bill me for this, Eric?
I am. Yeah, it's on its way.
Oh, goodness. Well, you know what? Let's shift. Let's go into, we haven't just described non-QM.
Yeah, let's do it.
Do you think non-QM, or do we describe QM and then kind of take it from there?
I'll bounce off of how you want to do it. I think when I do presentations either to the public where you would invite me or realtors would invite me to just be a part of the masses, the first thing we're overcoming is the past, right? Hey, your loans sound very similar to when I owned a home in this certain time frame. Prove me wrong, right? And so it had to come up. The industry had to come up with something creative. I just don't know if I would do it the same way. Non-qualified mortgages, right?
Yeah.
So in terms of what you sell versus what that is, I think maybe you jump in here and
Yeah, so basically we had the foreclosure crisis. That's what we're going to call it. In 2006, we started seeing, issues. I don't even want to get into what caused it all. I mean, in supply and demand, portfolio products, over-leveraged companies, bad borrowers, no money down, over-leveraged lots of things caused this. At the end result, there was chaos everywhere. There was bad lenders, there was bad borrowers. And I will say that. There was, shady borrowers, there's shady lenders, whatever. So the government stepped in and said, hey, let's blow the whistle. Let's come out and clean the playing field. And so number one, everybody that was licensed, typically I had a Department of Real Estate license. That was how we did mortgages back in the day. We had now the national mortgage license. So nationwide, they came out with a license for everybody, every state. Some states had zero licensing requirements, right?
Yeah.
And then in certain states, there's additional endorsements that you have to add on, California, Nevada, Arizona, whatever, additional tests, additional requirements for their protocol. Great. I think this is a great positive thing that came out of that. The other is for the consumer. How do we protect them possibly? And so we create this safe haven that we have lender requirements that if the lender follows it, and I'm going to kind of highlight what they are, there's a maximum points and fees. There's no risky features, no interest only, negative amortization, no balloon payments. Maximum is a 30-year amortization. There was also a max debt to income ratio. And the biggest one is the ability to repay. So we have to document income, traditionally tax returns and pay stubs, etc. If the lender follows that and we offer a loan, we're offering a great loan, but the consumer can't just say, hey, you put me into a bad loan. And so it's kind of a safe haven for the client, but also it's the consumer knowing that they meet all this, box requirements. That is, for the most part, if you're a W-2 employee, again, most of the time that fits very well into that mold. Well, there's a lot of borrowers out there, and it's just like, why do we have 3% down versus 20% down? Is we want to expand the horizons, right? There's many great borrowers potentially that are self-employed, but it is challenging to document it or the cash flow of how the income comes in. And so we're going to say it's an alternative method. It doesn't fit this small box like a traditional loan. Again, we've reiterated several times that a lot of self-employed solutions that come into play, that's what non-QM is. Yeah. It's, previous terminology was Alt-A, subprime, completely different. And I think there's a lot more standardization. There is always competition, which is good. That I think really brings the pricing, the rates competitive. But there's only so many investors out there of, hey, I don't want to repeat history. I'm not willing to do zero down and you not document your pool boy business.
Yeah, right. Angel Oak saw that need years ago for that underserved borrower, which was the self-employed borrower.
Yeah.
Okay, well, I'm a successful hairstylist, right?
Yeah.
And looking at us, it's funny that I came up with hairstyle.
Of all the industries.
I bring up hair. But what
we used to have hair.
We did. I don't know if it was good hair, but it was. So what does that borrower do? All right. So I don't have the W-2. I don't have the
a lot of cash business, right? And that's the industry. It's getting tips, hopefully, from each client that comes in and gets your hair done, and that could be a significant portion of your income. Maybe you don't deposit everything. Maybe you use some of that. So it's very challenging for that industry.
And that type of borrower comes with a story. Not to say that your W-2 borrower doesn't, but that self-employed borrower likes to share, hey, how I got into this industry, how it's grown from X to Y to Z. And that blends right into, as a lender, what does your credit profile tell me about yourself? What does the history of trade lines, your ability to repay, like you said, and then does that sync up with your deposits, right? To show to the lender, hey, your ability to repay is high, and that the terms are going to be better served for you.
Yeah.
And then if on the flip side, okay, I see that your credit profile is growing, right? We see recent trades that aren't 4, 5, 6+ years old. They're newer, all right? And then it comes into, okay, you have been renting, but we can't pay or prove that you've been paying rent. And those examples are where a lender goes, not that we don't like this credit profile, because this is what we want, first-time home buyer. We want our portfolio to have these type of up-and-comers to our industry, but the loan terms aren't going to be as attractive. So there's layers to this thing, right?
And everything that I explained to the client is, the higher the risk is the higher the rate. Yeah. And that is the direct correlation. And you have to understand that. I was flipping on the borrower. Would you lend me $500,000? Would you lend me $700,000? I mean,
no. No, kidding.
Oh goodness, thank you. I appreciate that. He's full. I've nothing but compliments, and he's bashed on my hair, and he's not lending me money.
All right, I'll refocus.
I'm giving you a hard time. Thank you. No, but that's the same thing. What would I ask of somebody that wanted to borrow money from me? One, at the end of the day, a lender has two goals in mind. They want to make money on the interest, and they want to get repaid at some point, right? So, it's, if you break it down, it's all reasonable of what that is. I think, especially with the non-QM, though, I think we do get higher in the weeds of what is the credit profile, how long has it been established, how long are the trade lines, more of the rental history kind of.
Yeah. And it's not this, like you were sharing earlier, it's not this black and white lending, right? Or the guidelines is, there's workarounds as long as there's reasonability to them.
Yes.
So although the higher the rate, we might be more flexible of, hey, if you don't have our reserve requirement, Angel Oak is offering gift funds. Gift funds are allowed. So if there's a family member, right, that says, hey, I'm willing to write X check, we're going to put it right into escrow for our client. Okay, well, that we can lower the risk of loan to value, right? Brings the interest rate down. So just one example of Although you might not look like the terms how you came into your office and said, hey, this, but we can offer you this. What do you think?
Yeah. Yeah. Well said. So, yeah. So I think we've done very well of what is non-QM, what is QM. Maybe we share some of the programs. I mean,
Yeah.
You know, you want to take it away here?
Yeah.
Without further ado.
Yeah, hey, happy to be here. I'd say instantly it's the bank statement only program,
Yeah.
right? The questions we get is, hey, do I have to go back 2 years? Do I have to go back 1 year? Right now, pricing is almost similar or identical when it's 1 year, right? Now, if your income history shows me better, then absolutely bring me 2 years. And that's part of the gathering process that you'll say when you bring it in. So a bank statement only loan, no tax returns are going to be shown, up to a 90% loan to value, up to a $2 million loan amount is available and popular, especially in California. So by far, bank statement only.
Let's kind of get a little details. They can be personal or business bank statements, beginning suggesting 12 or 24 months. We're going to average the income. We have calculation worksheets where we do that. We're going to back out transfers, non-business like deposits. I mean, we look through the bank statements and we're looking for consistency and cash flow.
Yeah.
Right. And then there's go ahead.
On the flip side, if the type of industry is inconsistent, will show me that inconsistency, right? So if you are a realtor, right, are you going to have every month deposits? You could. You're going to be in the high 2% of realtors, right?
Sure.
Or if you bring me 2 years of bank statements, that 2 years shows there's consistency in the inconsistency. And so that's And
I think that was a great example because I was sitting here scratching my head of like, when have I gone back 24 months? I really rarely do but that's a good example of the industry that you're right, is not as consistent. You're not going to show $50,000 per month as a business. Now, we also take into mind there's expenses. We know that, right? So kind of based upon the industry that you're in, there's different ways to do the expense ratio. And we're not here to regurgitate guidelines for you. We're just trying to explain. We're very considerate in the way that we look at that alternative.
And I'd say the expense for the business that you were referring to, when we look at the 12 months, let's just keep it there, of, okay, what type of industry does your borrower own? Okay, he's a musician. All right, so he has no employees, he has no brick and mortar. He's just out there strumming along, killing it. That expense ratio is going to be very low in our mind.
Sure.
Now, that's where the CPA comes in to reiterate what our assumption is.
Right.
But just like a realtor, not a broker, just a realtor, little to no overhead, no brick and mortar, no employees.
Right.
On the flip side, you own a restaurant, which I frequent. There's a lot of great restaurants out here.
Grocery store restaurants, you're squeaking a 10% margin.
Yeah. Auto dealerships, right? A lot of overhead, a lot of new ground up construction. So there's on the flip side, those are heavy in terms of we know, there's a lot of overhead. So we'll be conservative on the amount of deposit. So again, the story of what you do is how we're going to calculate.
Yeah. Okay, bank statements. I think we got it there. What's DSCR?
DSCR.
What is a DSCR, Eric?
DSCR. Goodness gracious. When I do, I keep giving my presentations when I'm doing those.
You're presenting right now.
For realtors, debt service coverage ratio.
Yes.
Okay, to answer that, and then so the consumer goes, well, what is that, right?
Yeah.
And when talking to realtors, I give them the key word of, okay, I'm going to get paid quick, which I love realtors, is the word stated. Okay, well then here comes the whole, oh boy, stated. Oh no, they were just saying that this isn't like it, but here's what it is. So the DSCR is borrower X owns and resides in a primary residence. Borrower X wants to purchase a rental property with the sole purpose of putting a renter in there. So now they're making passive income. Okay. So this is a seasoned homeowner.
Correct.
That wants to be a first-time investor, if so, or they own multiple investment properties that they want to pull cash out on to then go purchase another, or like you heard me say, a first-time investor. So there are programs that are very popular. And I want to get the word COVID on this, but back to the DSCR is There are investors, a lot of them, that love this type of loan because what you've shown to the lender as like an angel oak is your ability to repay is strong. You've shown me that you can reside in a primary residence for X amount of time. Now you want to be an investment. Why would you not put a renter directly into that investment property? Why the risk of, okay, well, it's a no income type of loan. Why is that not risky to the investor? Because again, we know you want to make that passive income very quick.
And I would challenge that. I feel it is income because we're going to document what the renter would pay in income.
How would they do that, my friend?
In rental, but going back, and we'll talk about just basics of how this works. This is not a new concept, and that's what I want to share. This is how commercial lenders have done this for eons, and it truly makes sense that, historically in residential lending, 1 to 4 units, you could purchase an investment property showing 0 rental income as long as your personal income supported it. For residential lending, if you buy a rental and it's going to be a $4,000 a month liability and you bring in $3,000 a month, you're going to carry a loss of $1,000 a month. Residential will they'll allow you to do that, which is kind of like, really? That's a bad business. And that's what I explain to all my clients. If you're buying an investment property, take the emotion out. This is a business. Do you want to purchase a business, not a charity? Don't put Uncle Bob in there. Do you want to purchase a business that is negative cash flow, that you're going to have to write a check or supplement each month? So adversely, how does the commercial lender do this? We're going to use really easy math because without a calculator, I'm just not there.
I love it.
If your mortgage, your liability for that property is $1,000 a month, commercial lenders want to see the debt service that you're bringing in 100 to 130 to 140%. Commonly is the debt service ratio that they would like to see, meaning you're bringing in $1,300, $1,400 of rents in order to pay $1,000 of liabilities. Okay. That makes sense, right? That means from day one, you're positive cash flowing. That is a sound investment. Why would we not want to do this in residential if we could? And so it's, how do we do that? Is we document through appraisals. Mm-hmm. You have some spiffy ways to...
We do have spiffy ways. Yes.
So share us on your rents.
But what I was going to say on the COVID term is there was a concern of these type of loans performing, right? Of, okay, look at our portfolio. How many DSCR loan, investor cash flow loans we have? Those loans were performing better than our bank statement only loans.
Oh, wow.
Yeah. I love sharing that little nugget of to take away the, ooh, those are scary. Now that we're talking about this, that's what we thought.
Well, it makes sense. You have an investor, somebody that owns 5 or 10 homes, typically do pretty well, right? You don't want to lose your empire, bottom line, right? So you want to grow your empire. And that's commonly what I see is when you get to 5 homes, now you want to start buying units and 10xing that stuff. Yeah. So,
and then to your question was, how does it work? So if you're not providing me income documentation, like you said, we're going to order the appraisal, which is mandatory. The appraiser is going to show us the average rent for the area, the 1007.
Yes.
So Angel Oak will grab that data and we'll say, okay, the 1007 is telling us that the average rent is $3,000. Does our PITI payment match, or is it lower than the $3,000? Okay, so that's the 1-to-1. You were given the example of commercial, so here comes residential. Of we want to see for the least money down, that debt service coverage covering 1-to-1.
Sure.
Let's say it doesn't. Does that mean we have a dead deal? No, because our investor has tiers to this. What is the actual debt service coverage ratio if it's not meeting 1-to-1? And based on those percentages, we're going to need a higher FICO score and more money down if we're going to do a purchase.
Yeah.
The last question I get is, well, is there a minimum, right? Can it be completely upside down? The answer is yes, it can. We do not have a floor as long as you meet our credit and down payment requirement.
Wow. Yeah. These are more make sense guidelines, right? how are you mitigating the risk? Maybe it's not going to fully cash flow, but you're coming up with a larger down payment. That's minimizing risk, right? So higher credit score, proven history. You have to work for those credit scores. So makes sense to me. Absolutely. So the only clarifying thing here is the 1007 in an appraisal. What is a 1007 is if you're purchasing an investment property, it's a comparable rent schedule. So the appraiser not only determines the value, what is comparable sales. Okay, the home is 750,000. They call around property management companies, do their research. What are comparable properties renting for in the current market? So clarifying what that is. Good. All the acronym. I'm sorry, I'm stepping on your shoes. I'm trying to get you back for the hair jokes. You know, every industry has our acronyms and our internal lingo, and I just always like to, you know, for the lay people out there, what's a 1007? Boom. Well, we got you covered.
Well played. Well played.
Yeah. DSCR, bank statements, P&L.
P&L.
I believe we've done a P&L loan.
We have same type vein as the bank statement only borrower.
Yeah.
Okay. So let's just say the average income dividing up over 12 months, we take a 50% haircut or whatever that percentage is for the business. Let's just say that income number doesn't get us where we need to be to qualify for the type of loan that comes in. That same CPA. Okay. We're coming back and we're saying, okay, tell me the story of the profit and loss for your borrower over the last 12 or 24 months. And let's take that income to use to qualify for the loan. So very brother, sister. And
a tremendous opportunity. I'm going to explain, you know, a good win that I've had with this type of loan, the P&L, is, you know, a client, and think about it, for self-employed, lenders look at tax returns. We feel that's the closest. Whatever you put on your tax returns is, hey, if you're willing to file that to the IRS, that's great. Now, how frequently do you do tax returns? It's once a year. So you have one opportunity to be able to claim your income. Now, if you're like most businesses, the goal is to grow your business every year. So I had this client that 2025 was good. Year to date, 2026 was exceptional, right? It was, you know, growing. That's what we want to see. How do we document that is when we're saying a 12-month bank statement, it's the preceding 12 months. So it's not necessarily the calendar year. Right now we're in August. We would want to see up to typically July 31st, 12 months pass. So now we have an opportunity to capture the income real time that does support the repayment of that loan. So that's a huge opportunity.
It is. Yeah.
I don't think a lot of consumers know about that, and I think that's a good one. There's checks and balances. I think some of the programs you have to support it with a few bank statements, some don't. Again, it's just different risk levels, and we're not going to get too into the weeds with a lot of that stuff.
Yep.
Non-warrantable condos.
Non-warrantable condos.
Oh, I think this is such a growing business, and again, we have the non-QM specialist and we have the condo specialist chatting about condos, and you know that's my self-proclaimed, and condos is a love-hate relationship. You get good at them because there's a lot of challenges to overcome.
Well, I'd say condos are cool. You know, can you agree to the condos are cool? What I think you're trying to get across to your listeners is the 30-day close will still happen.
Yes.
The need to quickly get particular documentation from the condo project is critical.
Yes.
For everyone to be smiley, happy at the end of the close.
Yeah.
And so we as a lender are very specific of the items we ask for you to gather.
Sure.
And the challenge, where I think your frustration is, not to put words in your mouth, is the condo project doesn't necessarily play by our rules of when we need things. They love putting in a little extra cost. You want that? That's great. I can get that for you, but who's paying for this? So how do we mitigate that? How do I show your client what exactly the lender needs to approve before we go into contract?
Sure.
And if that condo project is not going to provide X, what can I give you to show you that, hey, if they're not going to give it to you and you're going to pay for it, this is specifically the questions that the lender needs. And here's the answers as well. If this answer is not going to come back to us this way, we will not be lending in that project.
Sure.
So it's very much tip of the spear. Condo, we've got to go.
It goes deeper. And this is where I think when I sit down with my initial consultation with clients, I ask, are you interested in just a single family residence? Are you also open and interested in townhouses, condominiums, manufactured homes? I need to know, because the property type makes a significant difference in program availability, options, requirements, even the closing costs, as we're discussing condos. Now, a condo, and this is how I like, how do we keep in layman terms? You're technically only purchasing the walls in. And I know in, client A's little world, that bubble of, hey, I'm just buying my condo. Why do we need to care about the association? There's lots of reasons. One, for the financial integrity of it. Why is, think about that. If it needs a roof replacement, you aren't covering that. The HOA is. So that's huge. One, we need to see their master insurance policy that Eric's suggesting. We need to see what is their coverages. Who do they cover? How much do they cover? What's their deductible? All of that. Is it cover walls in? Is it betterments and improvements? All this terminology that we are looking for to vetting that on your behalf. So that's the insurance. But the second part is the budget. What's come into play, hot topics with condominiums in the last 5 years, deferred maintenance. And that, I think, was sparked from the Florida condo complex, sadly, that collapsed in the middle of the night. Terrible tragedy. It's on the beach. The salt air eroded the concrete, and it collapsed. So again, you may go into it just thinking about your unit, but I want you to think about the structure as a whole. Who's doing the repairs and maintenance? Does it need paint? How's the structure? How's the balcony, right? We have balcony laws to make sure that they don't collapse. There's a lot that goes into that. So budget-wise, we're going to look at the budget. What is your budget? When's the last time it was reviewed and audited? We're going to look at how funded is that budget? How much are the reserves in that budget? There's a lot that goes into that, right?
Yeah.
And it's all for the protection of you. Yes, it's for you. Yes, it's for the lender. I'm going to say it's two-sided, but really, if we can lend on it, then have the peace of mind that you're going to get into something that is, sound for the most part. Now, are we 100% vetting them in every capacity? No, we're looking at some of the highlights. Now, as a non-warrantable condo, does that, loan, does that mean we're putting you into a bad or a higher risk? No. Again, if we go back to the agencies, they're very black and white. They're very archaic in some of their thought process. And actually right now they're raising the reserve requirements, going from 10% to 15%. We're already seeing this non-QM grow, the non-warrantable business, but it's going to be even larger, where a normal conventional loan, standard conventional loan, I don't want to say normal, standard conventional loan will not maybe fund that property anymore. And so we have to have solutions that are looking at it, still vetting it, still getting us the answers, making sure that it meets guidelines, but, overcoming some of these obstacles. And I'm going to give an example. Insurance costs has gone through the roof. And here locally in Camarillo, I have a client that came to me and they wanted to purchase, and the master insurance premium was going to go from like $65,000 to $250,000. Okay. So the board members voted to not renew it at the same coverage. They chose to cut the insurance requirements. And now they made that association non-warrantable. And I had clients that came to me, they were in love with the property, they wanted it, I explained it to them. We went with a non-QM loan to get them into the property. Now, the challenge, and this is what ultimately she had to do, is homeowners are making decisions without consulting experts. And that's what I find on a lot of these, where do HOAs go wrong? That's always a bad bad formula, right?
Yeah.
So you need to have an insurance agent who's insuring that master HOA. They need to have their hand in communication with all the voting board members to make sure that they're properly advising them. Hey, before you cut that insurance, we want you to know. They actually went against their bylaws by trimming it. And so the borrower that I helped get into there, she got into the complex knowing what she was getting into. She got in on the board and she was a spoken voice. And that's what it takes, is sometimes having a voice, having a reason. Hey, we got to make these better decisions. We were able to refinance her. And, that's a perfect story of just trying to help somebody. We provided a solution to get them into that. 2 years later, we refinanced them. Hey, win-win, right? So
For someone who doesn't like condos, man,
oh,
did
goodness.
you just show off right there? Yeah.
Well, here's the thing. Why do I say maybe I don't like condo? I don't want to say that. It's a lot of work. It's a lot of leg work, and it is a lot of finance. Out-of-pocket costs, whether they're funding it or I'm fronting it on my credit card. We have to order insurance. We have to order the questionnaires. We have to order the condo documents. There's an expense. And so people are saying, hey, prior to getting into contract, why don't you review that? And guess what? It costs money. Do you want to invest $1,000 not even knowing that your offer's going to even be looked at or accepted? Like, you don't. And so it kind of works backwards. And so once that counter starts, yes, we have to hit the ground running, making up for lost time to gather those documents. Unless you want to pay additional rush fees, etc., it can get costly. And
Should we move on? Are you gonna? And we get.
Yes,
deep breath. Deep breath.
I need the doll, the little condo doll that I'm squeezing over here.
Very intense.
Again, I want to paint the actual picture in a nice way. And again, I love helping clients, condos. Bring them on. We got you. We got you experts here to do that. I want to reinforce it's going to be continued a growing market. It's a lot of different reasons that a condo could be non-warrantable. Yeah. And we got you.
I'll help you transition out of that mindset.
Please.
How about HELOCs and closed-end seconds? What are your thoughts there?
Here's my wonderful thoughts. It is kind of a newer niche, I would say, for the non-QM world. We have a lot of borrowers that are still dragging their feet. They don't want to move. They don't want to refinance. They've had their house for 10 years. They were able to refinance at an exceptionally low rate, but they're sitting on all this equity. And people get antsy. They're saying, hey, if I don't want to move, well, I might as well remodel my house. How do I do this without refinancing and getting rid of that rate? And so the opportunity here, it's been around for a while, is always, put a second mortgage, a HELOC, a HELOAN, whatever that may be. And so in the last, I don't know, has it been 24 months, 12 months? It's close in seconds.
Yeah, I'd say 18. And because you're educating that same musician, that same restaurant owner that might come to you going, hey, what do you see about the market? Where's the rates going, right? We can't give them specifics on that, give them best. That conversation normally goes right into, well, here we are with a HELOC. Would you like to have some money on the side if needed, if choppy waters you're anticipating, and that same, we're not touching your first self-employed borrower, but give me your bank statements again, and we can put you into a HELOC or a closed-end second. Yeah. Very, very popular, which goes to show you the state of the market. I mean, that's right. There's concerns.
Yeah, so this has definitely been a rising product. Successful. I've definitely used it. Also, borrowers want to, they see the value in owning real estate, right? Historically, year over year, nationwide, I'm going to go back 60 years, it appreciates 5 to 6% per year. Now, is it the stock market at 10% always? No, but I think it's twofold. One, it's an asset, but the stock market doesn't always pay dividends, right? So if you could have a cash flow, you're acquiring another asset, double down on your wealth, let that continue to grow. People see the value of that. And so a great solution, they take the equity that they have possibly in their primary residence or another investment property. They do a closed-end second, documenting through bank statements. Now I can put down 25, 30% on my next purchase, boom. It's a path that I think is an excellent solution to get into that.
Hey, great question for you.
Yeah, there we go.
You're welcome. Yeah.
I want to talk about just and I got a little stats here of the market share of non-QM because people maybe we need to be the pioneers here to come up with a new name for it. So it's not the non-QM, it's the self-employed opportunities. And there are loans. We're not getting into the weeds of every single loan that's out there. I'd say a heavy focus on self-employed, but you don't have to be self-employed. There's W-2 employees, 1099 employees. There's different programs, different solutions that it encapsulates. So we don't want to just pigeonhole it exclusively for the self-employed. In 2020, the market share was less than 3%. 2023, about 3 to 4%. 2024, 5%. Funded between 80 and 90 billion. 2025, we're not even a year from that. It blew up 8 to 10% of the market share, $239 billion in volume, and 698,000. We're going to round up 700,000 loans. That's 700,000 families. That's there's a lot of, you put that into perspective. That's a very large reach of opportunities that people were given had they not had the non-QM that probably wouldn't otherwise had been there. And it's still growing. I think this year it's expected to be 7 to 9%, maybe more. But again, the market in that short of time is tripling. It's exponentially growing.
Yeah, and the education part of it too. A lot of almost going here to go there again on what I was about to say is a borrower can be easily offended with a question to, hey, we see this on the credit, we see this on income. Can you explain to us what that is so we can resolve the underwriter, proposing, hey, what is the path? What would happen 2 years here? And I would encourage the listener to not be offended. We're not trying to poke holes and maybe something happened years ago or, hey, this deposit doesn't make sense. We know it's income based, but it's larger, than your average. Going back to the counseling and the encourager is we're not trying to expose something just because, right?
Yeah.
It's just when we go to sell these loans, they're going to ask, you don't want to hear from us again until you're ready to buy something else or refi. So we need to get all these questions handled up front. I think there's a lot of, well, why do you need to know that? Well, why are they asking for that? I'm sure you hear about that.
You can tell your friends how much you think they need to hear that you make. We need to see it. You can tell them how much you think they need to hear that you have in their bank account. We need to see it. So there's sometimes a little bit of a discrepancy. Now, on the helpful side, my approach is every single time I sit down on an initial consultation and I start out with a soft credit, I review that credit report. If you have a 770 credit, I'm still going to ask you, can I give you a few critiques to get your credit better? Man, I got 770. Everybody says yes, because the question is, I want the best rate possible. Well, there's a lot of variables that go into interest rate, but at 770 for a agency loan, their highest tier is 780 or higher. You're 10 points away.
Well, how do you like this? But my Capital One app tells me I have an 800.
Sure.
How do you deal with that?
And that's a great point. I do hear that response all the time. People are very open because they see that I'm genuinely trying to help them get the best rate, and I am. How do we improve it is one, or even just analyzing the credit. There's a lot that goes into credit and the industry that pulls your credit. So the auto industry and credit cards, a lot of them run different algorithms, mathematical equations of how they're weighting and scoring your actual scores. There's 3 different bureaus. We've gotten into trended data. So a lot of the trended data is not just like, hey, do you pay your bills on time? You have a 30-day late. We want to know part of the scoring, 35% is credit history. Do you pay your bills on time? 30% is usage, That's the easiest to fix. So when we're focusing on improving your scores, typically it's revolving or credit card debts. The weighted data is, are you a minimum payment person or do you pay extra? And that's adding the extra layers, and it's also understanding. I think I'm just going to throw out one more thing on the credit, and this is what I see all the time. And this is probably a pretty common practice for well-to-do clients, meaning they have a 750 to 800 score, is they love to put everything on one credit card every month, and then they pay it off, and they go, oh, but I pay that off every month. And my here, can I offer you a few little tidbits? And they say yes. And I said, well, maybe this was a month, we're summertime here, and you went on a vacation and you charged an extra $10,000. When I pull your credit, it's a snapshot at that point in time. Yeah, I can see that you paid off in full, but I see a $10,000 balance and a $300 minimum payment. And that's what I'm taking into account for qualifying your loan. That balance, even though you paid off and you're earning beautiful points for it to get some free stuff, it is bringing your points down. And I've had this people that could pay cash for homes. I say, prior to going into a transaction, be cognizant of that. And if you're going to purchase your home, maybe just take a 3-month hiatus of charging on your credit cards, using a debit card or some other solution where we can show those accounts paid off, because oftentimes I see it brings them down to a 750 credit score, 760 credit score. And again, I want to offer them the best that I can. Not to say they're bad borrowers. This is fine tuning. How do we look at it? And part of it is the credit score. It's the proven credit worthiness over an expanded period of time. And yeah, we can move 20 points here and there, but you don't go from a 580 to a 780 overnight. That takes years. You don't get an 800 credit score probably even in your 20s. You've got to be really savvy with credit to get that 800 credit score. Part of that is that how long have you had extended credit? And it's not 5 years to get an 800 credit score. It takes a long time.
Our average borrower mid-score is 720 plus.
Okay.
Idea.
Yeah. So anyways, there's some tips and tricks for you guys out there. Couple things. I know we've kind of been a little windy here, but it's good. This is all good information. I love it. I shared a condo story with a win. Do you have any wins that come to mind that you were the hero of, and you want to kind of pat yourself on the back a little bit?
Been a hero. The speed of transaction right now is, I'm impressed by that.
Yeah.
What everyone doesn't see, what I think we touched upon at the beginning, there's so many team members to get John Doe's loan closed.
Yes.
Right. And the synergy that we have had, the team building activities that Angel Oak puts on, it's neat to get the human being aspect of who is that underwriter, who is looking at their loan. Yeah. It sounds cliche, and of course, okay, Eric, you're going to say that, but there is excitement from getting your expectation of what I told you from start to finish is going to take this, and then when you send an email after it's funded, and then you say nice things about the team or just the people that were jumping in, that is where Angel Oak wants to keep doing better, because our industry is a month to month, right? It's where that loan is the only loan that matters. But to see in a very choppy market that human beings want to impress you, that's the fun side of what we do.
And then there's a lot of people that are, a lot of my clients, I think, very appreciative of what I do, very thankful, very, they're very genuine in that. How many reach out? Those emails mean a lot. Those phone calls mean a lot. Those text messages mean a lot. It's the positive reinforcement that we all need to say, this is why we're doing it. This is why we're answering our phones and staying up late and carrying the stress for you. My goal is to make it as simple and easy for you as possible. And so keep them coming. Thanks. I think that's a huge point. Great point.
Yeah.
Let's move on just real quick. not get too deep in the weeds here, but the market. Where do you see the next 12? Let's just keep it 12 months. Where do you see our industry? Mortgages, non-QM. What's your thoughts?
My answer is who knows? We went into this new year and we were cranking. You were cranking. We all were. There was huge optimism in the first quarter, right? And then things happen in the world.
Yeah.
And there's the confusion. There's the uncertainty, is that
Sure.
our word our mortgage world uses. And so if the mortgage world's uncertain, if the markets are uncertain, well, what does that mean for the borrower, right? Are we doom and gloom? Absolutely not. Because as you mentioned earlier, that we're still trending to do more than the previous year.
Yeah.
Not by much. We're not making any sales,
Records. But to sustain that growth, I think sometimes we don't often look at that achievement.
Yeah. And so there's definitely a need the consumer has, right? And we are hopefully known as the voice of reason, whether this could be a good loan for you, or I would say, hey, hold on real quick. Just there was a lender experience where family member calls different bank, they own a home, they want to refi their second home, and it was on a speakerphone, and the person on the other line, who I do not know, no one named the bank, just said within a minute, just saying, hey, looking at this thing real quick, I don't see where this could be a good opportunity. And I share that brief story of there are really good apples and there are some bad ones. And the quick, right? You referenced me, the quick answer to our job is to see where's the patient bleeding, or are you bleeding, or are you healthy? We need to assess that as fast as possible and give you the I say hold. Now, certain times the consumer doesn't want to hold, right? I want to push through. And that's where normally it could get a little in the upside down world. So trust us, I guess, if the consumer hearing us, in terms of we've done this long enough to know, hey, this is something that I would do. Would you do this? Yeah, I'd do this. It makes sense with your story.
Yeah. I like that. Trust us. Now, I'm going to throw this out there, and this is no disservice to box banks, but please don't go to box banks.
What is that? What is a box bank? What is it?
Where do you have your ATM card?
Oh, got it. Okay, that's a box bank.
Yeah. You know who they
Got
are.
it. I just want you to
they do a little bit of everything, and bottom line, they're going to be 9 to 5. They're compartmentalized. The underwriters are back east. Doesn't matter where underwriters are. You're not getting the knowledge base, the how-to of what these two experts in front of you right now that are going to provide to you. And so I think that's that phone call that other person had, was maybe that was a box bank. Yeah. It just doesn't fit their vanilla platform.
Right.
They want to do a little bit of everything, and to do CDs and checking and savings and be your financial expert. You're not going to do everything well.
Yeah.
And so leave it up to the experts. We got this.
That's it.
My quick summary on the 12 months, I think we've got some growing pains, and I think we have a new Fed chair, and they don't make, the Federal Reserve does not make, direct impact to mortgages for a long term. They directly impact primarily short-term banking rates, which can play into the HELOCs and things like that. He's got a good outlook, a good attitude, and he's looking to kind of change things a little bit. And I don't think the markets have really understood what he wants to do. And so I'm seeing a little bit more volatility in that. I'm hopeful. I feel that he is very intelligent and is looking at things right, of when we're trying to gauge inflation, why are we looking at reports from 12 months ago? This is skewing our numbers. Inflation is something every month that we look at and gauge it. We need to have a better, shorter trend to make these decisions. I think that's a brilliant way to gauge that. And for it to actually play out, I think we're going to have these little bit of growing pains. And we're seeing that with the volatility in the markets. The Fed surprised us this week by pumping some money into the markets as mortgage-backed securities and the 10-year treasury were suffering. So they're, again, keeping us nimble. They're keeping an eye on that. And I feel that more than ever more than some of the previous Fed chairs. So I see a positive outlook in our new Fed chair Walsh. So with that, I think, rates are elevated a little bit right now. I think that's going to subside. They ebb and flow. And I think if we just take a step back and look at the economy as a whole, some industries are struggling, some are thriving. It really depends upon where you are within that and what your industry may be. Housing is always a good investment. It's always a good investment. And, we're not talking to professional flippers, right? Because that's a very small niche of that. Most people buy a home, they live there for 7-10 years. So it's a long-term investment. Hey, you may have a year that's down, but really the value is when you bought it and when you sell it. And I can pretty much guarantee you 99.9%, we're not putting that 100% stamp on anything. I have the data. I'll show you the data. If we look at a 10-year trend, there's been one time throughout history, and that goes back to the foreclosure crisis, where in the 10-year duration, housing may have went down. Other than that, it's survived it all. And so it's still a good investment. Rates are keeping prices moderate, and I'd rather have getting in, acquiring that asset, maybe at a higher rate, but at a $100,000 lower price than rates were at 2.5-3%. Bid over ask was $150,000. I mean, it was insane. Yeah. And so if you weigh it out, it actually, for bottom line, for the payment, for the overall, the higher rates are helping the housing. We're just not accustomed to that. We're so rate centric. Everybody, what's the rate? What's the rate? Yeah. You didn't even ask me the payment. And you're saying it's too much. So
because again, we're competing with the next door neighbor.
And, of course. And Uncle Bobby, he's got the 0.9%. Good Uncle
stuff.
Bobby. Anyways, I go off a little bit on some of my tangents. I think, the market as a whole, I think there's a little bit of correction here, a little bit of finding itself on where we're at. I'm hopeful. We had a small piece of this, where the rates kind of dipped down about 1% lower than where they presently were for a short time. That felt good. That felt real good. Felt good, not just for my business, but for helping the consumers. I do see the non-QM continuing to grow.
We do too. Yeah.
I think that's going to be very thriving for me, with the non-warrantable condos, and also more consumers finding out that, hey, debt service ratio loans, I mean, I have clients that I can fully document income, and when they're that strong, you compare them. It's like, are you open to this other loan that I can get you the same rate and we can streamline this? Absolutely. Yeah. Why would we not?
Yeah.
So, well, I think that's, we've had a great conversation, Eric, and I really appreciate your time and giving your expertise on a lot of this. Any final thoughts or comments before we get going?
We appreciate you. I appreciate you.
Thank you.
Thank you. Yeah.
I'm going to be, I've fluffed you a little bit here, and we'll continue the showering of love here. There's two account executives that I have respect for, and you and the other one stand out highly. And that is something to be, I couldn't tell you any of my other account reps. It's not just knowing your name, but it's the service, the response, everything that you do to properly earn the business, and not just earn the business, but once the business is there, guide that ship into getting it closed. And so I want to thank you, and thank you for your time of coming on today to share that with our listeners. So, hey, thank you all for being here, listening to us. I know sometimes we get a little in our tangents, but that's the way it is. That's the business that we're in. So keep listening. We're going to keep bringing you some topics and experts in the industry. And on to the next episode. This is Greg Abrams on G Money, real talk on everything mortgages and real estate. We're out.